What if I told you that in the UK, the moment your bank gives you more interest, you can actually end up losing money? Yes, in a world where everyone is chasing higher returns, better savings rates, and bigger yields, there exists a bizarre UK tax loophole where, somehow, earning less can make you richer. It sounds like broken math, but it's real. It sounds like a joke, but it's built into government policy. And the strangest part, it's been hiding in plain sight for years. Today, we're going to break down how a loophole created by accident, powered by political pressure, and ignored by regulators, turned the simple act of saving money into a financial trap. Stay with me, because once you understand this loophole, you'll never look at high-interest savings the same way again. To understand how the UK ended up with a tax system where earning more interest can push you backwards, we need to rewind to the mid-2010s, a time when interest rates were near zero. Back then, savings accounts were basically decorative. You didn't save money for returns, you saved it because your parents told you to. The government, facing backlash for punishing savers, responded with a political crowd pleaser, the Personal Savings Allowance, or PSA. It sounded brilliant. Basic rate taxpayers, £1,000 of interest tax-free. Higher rate taxpayers, £500 tax-free. Additional rate taxpayers, £0 plus the starting rate for savings. A confusing but powerful extra £5,000 tax-free for low-income earners. On paper, more fairness, more support, more reasons to save. In reality, the ingredients of a loophole nobody noticed because interest rates were too tiny for anyone to hit the limits. But then came 2021, 2022, 2023, interest rates skyrocketed, not by inches, but by explosions. That's when the loophole woke up. Originally, these allowances weren't supposed to interact in weird ways. They were built layer by layer, by different chancellors, different budgets, different eras. One allowance was meant to help pensioners, another was added to help low-income workers, another was political PR during low-rate years. Individually, none were a problem. Combined, they created a mathematical Frankenstein. The key interaction: your tax on interest depends on your overall income, not just your savings. So if you earn just a bit too much from wages, side hustles, or benefits, your tax-free savings allowance collapses. That means a £10 pay rise from work can cause a £500 tax bill on your savings. Crazy. It gets worse. Imagine you're earning £17,500 a year. You qualify for personal allowance starting rate for savings, personal savings allowance. Add them together and you can theoretically earn over £6,000 of bank interest completely tax-free. That sounds amazing until your salary reaches the wrong number. If you earn just £1 above a threshold, the government instantly cuts your tax-free savings band. No warning, no gradual change, no tapering, just a sudden cliff. That means the moment banks started offering 4%, 5%, even 6% interest, thousands of savers suddenly crossed tax thresholds they didn't even know existed. People who had never paid tax on savings in their entire lives were suddenly receiving surprise HMRC letters, and then the internet discovered the horror. Sometimes, you're genuinely richer if you don't take a pay raise or if your savings account pays lower interest. Experts began running simulations. Financial forums lit up with panic. People noticed the most absurd outcome. At certain income levels, earning £100 more in salary could lead to losing up to £350 in interest tax benefits. Your effective tax rate? 350%. That's not a typo. This wasn't a glitch. This was legislation, functioning properly, but in a system that had never been pressure tested. Because for years, interest rates were so low that these thresholds barely mattered. But when high interest returned, the loophole became a trap. Suddenly, a pay raise could make you poorer, a promotion could destroy your savings benefit, and taking a higher interest savings account could trigger a tax bill that wipes out the gain. Once the loophole went viral, savers started discovering they owed tax for the last 2 years. HMRC systems didn't warn them in advance. Some banks reported interest incorrectly. People were being taxed on interest they didn't know was taxable. The fallout hit 3 groups. Hardest: 1. Low-income workers, the very people these allowances were designed to protect. 2. Pensioners with modest savings, often unaware of how their income interacted with savings thresholds. 3. Middle earners hit by the fiscal drag. Frozen tax bans pushed millions into higher brackets, triggering the loophole faster. And the most painful discovery: millions of people are now paying more tax on their savings than Billionaires pay on capital gains through their corporate vehicles. You'd think the government would reform this immediately, right? Wrong. Every time the loophole is discussed, the same arguments appear. Closing it is too expensive. Interest rates might fall again. Savers should calculate their own tax. It only affects a small number of people, but none of that is true anymore. Shocking modern data reveals over 2.7 million UK savers are now paying tax on interest, the highest number in decades. The majority were never supposed to cross those thresholds. Frozen tax bans mean millions more will fall into the trap over the next 2 years. Patterns repeat. Systems built for low-rate economies break when rates rise, and once again, ordinary savers are caught in the middle. This loophole mirrors other systems where earning more makes you poorer. Benefits cliffs, childcare allowance thresholds, student loan repayment jumps, pension contribution tapering, energy rebate cutoffs, each as a system where a tiny income change triggers a huge financial penalty. The savings loophole is just the newest and most mathematically absurd example. It's a sign of a larger issue, a tax system built piece by piece across decades without testing how the pieces interact. And the result, unpredictable punishment for predictable behavior. Higher interest doesn't always mean higher earnings because of interlocking allowances. You can slip into a tax band where your interest becomes taxable, wiping out gains. 2. The UK tax system creates cliffs, not slopes. Earning £1 more can cost you hundreds in lost allowances. Planning matters more than ever. 3. The loophole is the result of system layering, not intentional design. It wasn't built to trick you. It was built without thinking about what happens when interest rates rise. If interest rates stay high, or if tax bands remain frozen, this loophole will affect millions more. This isn't just about saving money. It's about understanding that the rules of the game have changed, and playing blind is now more expensive than ever. If you want more deep dives like this, the hidden rules, the financial traps, the loopholes that cost everyday people thousands, make sure you subscribe, hit the bell, and share this video with someone who still thinks higher interest always means higher returns, because the truth is stranger and more expensive than it seems.